Hi, I'm Quinn Nguyen at Intercom's, the Oil and Gas Conference in Denver, Colorado. Joining me is Robert Turnham, President and COO of Goodrich Petroleum. Good morning, Rob.
Good morning.
I want to start by asking you about your second quarter 2011 earnings and operational results. What drove your success during the quarter?
It's all about the oil volume growth. We've been pretty much predicting that would come, and we started to see the traction of that growth hit the second quarter earnings. We had 8% of our company production came from oil production, but it equated to 25% of our revenue. So it's a big, obviously, multiple on what we've been saying that we're going to do. So cash flow growth grew dramatically, led by the oil volume growth.
Now, you also drilled and completed your longest Eagle Ford well during the second quarter.
Right.
Is the technical puzzle coming together for you folks in terms of well design, completion stages, and such?
We've really been experimenting with lateral lengths. We started at 4,500 foot laterals, we went to 6,000 foot laterals, now 9,000 foot laterals, which I believe is the longest Eagle Ford well drilled to date. The concept is that once you're in the lateral, you can drill 500 to 1,500 feet a day, so you're making great progress at very little incremental cost. The results that we saw from our 9,000 foot lateral really are encouraging. We had a 25% increase in the initial production rate, but more importantly, we've seen a flatter decline curve. So over time, we feel like this is a more economic project. You're going to achieve a higher estimated ultimate reserve from the well, but most importantly, a higher internal rate of return. So I think you'll see us continue to test longer laterals.
Now, what about your Buddha line? Your company has seen some recent well success there. What similarities does the formation have to the Eagle Ford, and how does it fit into your long-term goals?
Buddha lime sits right below the Eagle Ford. It's a fractured limestone. It has more variability because you don't fracture stimulate it. The oil and gas is not necessarily trapped equally into the rock. It's predicated on naturally occurring fractures. So the concept there is you're drilling horizontally to intersect vertical fractures, but the fracture systems could have some variability, and therefore your results could have some variability. The benefit of it is that you don't have to fracture stimulate it, so the cost is much lower than an Eagle Ford shale well. And you're going to see us continue to test the Buddha. We think you will see some variability of results, but at a $3 million completed well cost, your threshold or hurdle rate's very low. You can all you need is about 60,000 barrels equivalent to achieve a 30% rate of return. So in these days, at these commodity prices, it makes sense to continue to test that. And we have plans to do that. We've also, we will be fracking our first Buddha well. We drilled in an area that has been very good and productive for the Eagle Ford shale. We landed the lateral in the Buddha, and we're going to frack the Buddha in an attempt to get not only the Eagle Ford stimulated, but also more production out of the Buddha. So that'll be kind of a combo well that should drain both the Eagle Ford and the Buddha.
Now, do you have any near-term financial liquidity goals to help fund operational objectives? And should we expect to see any non-core asset sales?
Yeah, in our second quarter press release, we did announce that the board has authorized us to look into non-core asset sales or possible joint ventures, and we're doing that right now. We have a couple of areas that are not getting enough attention, not enough allocation of capital, including an area that we call the Angelina River Trend. It's extremely economic wells. They're big wells, they're gas. We have plenty of gas in inventory. So we're looking into the possibility of joint venturing that or carving off a third of our position and selling that. It would allow us to recapitalize, accelerate development in that field and grow cash flow. In addition to that, we have some old legacy assets, vertical production in the Cotton Valley in particular in East Texas, and it's low rate of return. If we can perhaps sell that, roll it into higher rate of return projects, then that's something that we would have an interest in. Don't have to do it, the balance sheet's in good shape, but if we find the right valuation, then we're going to look into that.
Is there anything else that you want to share with us?
No, we're doing what we said we would do, which is grow oil volumes, and with that growth comes an expansion in cash margin. We think we'll be 15% oil by the end of the year. That would equate to about 40% of our revenue. That continues to expand. into 2012. We also have a frontier play called the Tuscaloosa Marine Shale. It's early in those days. We have the most leverage per share in the Tuscaloosa Marine Shale if it works. It's an oil play. Both Devon and Encana are driving that process now, drilling wells, and our expectation with success would be to start drilling those wells in early 2012. So very exciting times for us. We're getting more diversified from a commodity standpoint. Production is growing, costs are remaining low, and cash margins and cash flows are expanding.
Okay, well, Rob, thank you so much for all the insights.
Thank you very much.
I'm Quinn Nguyen for oilandgas360.com.